The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome to Options Bootcamp, and I just love that theme music. It gets me in the mood for some options education and some options discussion. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-evolving Options Insider Radio Network. And I am joined today on the program by the man, you know him, you love him. He is the major domo over there at Sogo Trade. He is none other than John Critchley. John, welcome back to the show, sir.
I am ecstatic to be back, waiting for our other drill instructor, Dan, but great to be back. Excellent topic today, one of my favorite topics, so I'm looking forward to it.
Yeah, it should be fun, and as you mentioned, we are sans our other black hat drill instructor, Mr. Dan Passarelli. He's caught in traffic, I believe, so hopefully he'll be joining us momentarily once he gets everything worked out on his end. But while we're waiting for him, we're going to keep on rolling right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, listeners, welcome to the basic training segment. And as I promised, our fellow drill instructor has finally fought his way through the traffic to be at your side here for the program. We are joined by none other than Mr. Dan Passarelli from Market Taker Mentoring. Dan, welcome to the program. Late is better than never.
Thank you. I am glad to be here. I'm really glad to be here, believe me.
Now, Dan, today's topic du jour is an interesting one, and I'm sure this is something that you deal with quite a bit over there at Market Taker Mentoring with a lot of your clients, because this position does seem to resonate so much with the basic retail options customer. Of course, we're talking about straddles. What do you counsel your clients? And I'm sure there are many of them who come to you and say, hey, Dan, I learned about these straddle things. I want to buy these. I can make money no matter what happens. So what's your first takeaway, and what do you usually walk them through when they approach you with that type of scenario?
Well, I tell them basically forget everything that you think you know so far. For the unassuming trader who reads about it in one chapter of a book and looks at the V-shaped profit and loss diagram, if you go in and try and trade a straddle like they teach in the textbooks, you're probably going to lose money. Straddles are much more complex than people think. straddles, because you're buying two options, you're kind of doubling your risk. I worked with some traders back about 75 years ago when I was a clerk. I worked for some traders, and they would talk about individual options, spreads, and straddles, stating very, very clearly that straddles are not spreads because you're not spreading the risk. In fact, you're doubling the risk. Technically, you spread the delta risk. You make the delta small, but you have double time decay. You have double gamma if you're selling. If you're a buyer, that's fine. You have double volatility risk. So these guys who go out there and they just heard of a straddle yesterday and they say, oh, this is a great way to trade volatility. I think the stock's really going to move. And they go out and buy a straddle and plan to hold it and wait until the stock busts through the break even. You know, that's kind of a sucker bet. In fact, in my second book, The Market Taker's Edge, I don't remember if it's a chapter or if it's just a subsection of a chapter that is titled Straddles, the sucker bet.
I love it. And I think we'll get into that in a minute, because I certainly have that down in my notes as well about the shall we say shadier side of straddles in the options market and how they come to have really personified a lot of the more dubious pitches we've seen. But perhaps maybe, John, you want to kick us off here. Why don't you give our listeners a basic overview of what we're talking about when we're talking about straddles?
Well, a straddle is a very simple strategy. It is buying the puts and calls of the same strike price of an underlying. In other words, Apple is trading at 450. You buy the 450 calls. You buy the 450 puts. And basically, what you do there is you're making a play. You're making a play on movement. If you pay $8 for the straddle of a $100 stock, that's basically implying an 8% move if it's 1 day to go. So a straddle is basically, if you buy a course, it's a long premium play. You pay a debit, you pay $8, you own the straddle. Now, if you sell it, on the other hand, you collect that money, and you have the ability to collect $8, but you have unlimited risk. So the straddle is a very basic long or short premium play, and you're basically, if you're long it, betting on a movement up or down. If you sell it, you're basically betting on no movement. So it's a very basic strategy for the retail customer.
Yeah, I mean, that's why it's been embraced by so many people on the educational front, and perhaps some of the more dubious educational, even some of the more dubious brokerage front who like to embrace the straddle. You know, they use it for exactly that reason, because it is so basic and still so enticing for a lot of retail options customers. Now, I think the benefits to the straddle we just clearly outlined for you. That is, you know, you're looking at a stock, let's say XYZ, or perhaps everyone's favorite Apple, and you're not really sure which way this thing's going to go. It could go up, it could go down in the near term. So the straddle makes you, or gives you the option, pun intended, to participate in the movement in either direction, which is a nice thing. Instead of just buying that at-the-money call and hoping the stock goes up, you're now also buying an at-the-money put. And then if the stock goes down, well, you're okay there too. Now, I think the more savvy among you out there, at least those of you who are familiar with basic math, can instantly see the downside to doing that. And that is, of course, you're not just buying one option, you're buying two on the same strike. And that usually comes with a much higher level of cost, particularly for a lot of options traders who usually focus on the out-of-the-money options that are usually a little bit cheaper. Getting into straddles will then involve at least one in-the-money option, or if you're doing at-the-money options, you have all the at-the-money premium built in. No matter which way you cut it, straddles are an expensive way to trade. Remember, you're buying exposure in both directions. That doesn't come cheap. So the very, very obvious and first downside to purchasing straddles, and of course we can flip that on its head in a minute for the selling portion, but the obvious downside towards selling straddles is that expense. You're paying essentially double the freight to do this trade. So wherever the stock moves, you may have thought the underlying was maybe going to move $5. Now, if you're buying two at-the-money options for $5 each, now you just paid $10. So now you really need the stock to move double what you anticipated, perhaps, just for that trade to break even. So it quickly becomes a difficult road to hoe for a lot of newcomers to the options market who like to focus on the long premium side of the equation and they see straddles as, hey, here's the great way to make money when I'm not really sure what's going on in the marketplace. The downside of that is you're clearly outlaying a lot more money than you would have, and so that, of course, has a lot of tangential effects on your break even when you're looking at these types of trades. Also, when you're doing these trades, a lot of people will like to buy at the money straddles. That's a very popular trade as well when you're looking at straddles. But as we talked on previous shows many times about the Greeks and their impact on options trading. And now when you're looking at an at the money straddle, remember we've talked on previous shows about things like gamma and theta. Those are both highest on the at the money strike. So when you're coming in and buying an at the money straddle, as many people are prone to do, not only are you paying much more for that position, you're also putting on two options positions that have very high gamma and very, very high theta. So they're decaying at a very rapid rate. So you're buying a position that is very expensive and also decaying at a very, very rapid rate. So that makes the straddle even more difficult when you're looking to implement it and trading effectively. Because you might think, hey, I got some time, I'm buying all this premium, it's going to work out for me, but that premium is decaying at a very rapid fashion. So you need to take that into account whenever you're trading straddles. Now, John, a lot of your clients, I'm sure, come to you when they first learn about these trades and they say, wow, this straddle is a great type of strategy. I can't lose. How do you counsel them? What do you walk them through when they first approach you and say, John, what do you think about buying the hair straddles?
Well, the main thing that I always advise is that in general, the straddle is best utilized, and the best time to use it is when there's an event-driven event, earnings, FDA ruling, a proxy event, a court ruling. That's the easiest way or to use a straddle. In other words, earnings are coming out in Apple or Netflix, and the at-the-money straddle is implying an 8% move, and that is a very easy way to understand a straddle. There's 1 or 2 days to go, and if the stock moves 8%, that's your break even. So I try to buy a straddle with no earnings or no event on the future. It's much more difficult, I think, for the retail customer. There's more, for me, it was always event driven. But another thing I want to mention also is that if you want to, straddles can also be implied volatility plays too, because it's actually one of the purest ways. Maybe Mark or Dan can speak to this later in the podcast, but there's also a way that by buying a straddle, it's also an implied volatility play. But that's maybe a little more sophisticated. But the thing I also wanted to mention real quickly about the straddle is that on the long side, it can be very expensive. And later in the podcast, maybe we'll go over it also. But a lot of retail customers have difficulties with all the premium. Now we have minis, which maybe customers can trade. But there's also a way to do a butterfly or other strategies or strategies called strangles. And that way you can lessen the cost and not have the huge outlay of the straddle. So, for example, if I have a straddle that's implying a 10% move, instead of buying all that premium, I may look up 10% and put a butterfly on, or down 10% and put a butterfly on. So there's a lot of different ways to look at straddles, but just be careful buying them and be careful selling them. Make sure you know what you're getting into.
Let me just add to that as well. The Greeks are incredibly important to trading straddles. Like I mentioned earlier, there's double theta, there's double gamma, and there's double vega. So, if you already kind of look at the Greeks and think, oh, well, they're kind of important with my strategies, they're twice as important now. Compared to a spread like a vertical spread, they're like 10 times as important because they're so big and profound and have such a big effect on your potential profitability. Volatility, huge component of this. Straddles can be incredibly expensive when volatility is overpriced, or they can be incredibly cheap when volatility is underpriced. That's your vega. As far as your gamma and theta goes, you're doubly punished as time passes, and you're doubly rewarded when the underlying stock moves. So because of the big vega, because of the big gamma/theta, straddles are the quintessential volatility strategy, and the Greeks show that.
Now, John, You've hit on a couple of things that I want to address in a couple of seconds. Of course, the volatility component of straddles and the earnings use case. But I know I can hear a lot of our listeners right now screaming into their iPod or iPhone or into their podcast player of choice saying, well, if these things are so dangerous to buy, I just want to sell these things. So that gets us to the other side of the coin, the short straddle trade. And you're right, it is an enticing trade for premium sellers out there to get essentially twice the premium. You're doing an at-the-money trade. You're putting on now two strikes at the money or two options at the money. So you're getting twice that decay. You're getting twice that theta, twice that gamma. It's a lot of interesting and attractive things for a lot of traders. Of course, it's not as easy as that, just putting it on and having things decay your way. Of course, if you're selling an at-the-money straddle, or any type of straddle, really, you're betting that the underlying is not going to move. You really want this thing to sit right at the strike where you sold that straddle and not move at all. That is the ideal scenario. It'll sit there, it'll decay faster, and hopefully you get to keep most, if not all, of what you initially sold that straddle for. Of course, it rarely, if ever, works out that way, which is why people use some of the strategies that John alluded to earlier, some of these strategies with wings, like the Iron Flies and the Iron Condors, as ways to take the short straddle phenomenon, the ability to collect all of that time decay, all that theta, and to still hedge your risk on the outside. So, John, it sounds like from your comments earlier that that's kind of your preferred approach, and that's what you counsel a lot of your customers over there at Sogo Trade when they're looking at perhaps sell straddles, that they should add those little, shall we call them kicker or hedging components to make sure the straddle doesn't move against them in some really disproportionate fashion.
I mean, absolutely. I mean, when you sell straddle, remember that you have a limited reward, and especially going to an event like an earnings or an FDA ruling, it's very hard to sell straddle for $8 and buy it back for 20-30 cents. I mean, even the best traders. So again, when you sell something for the premium, it's very hard to collect the full amount. Stocks normally do move something after these events, so that's one, I think, misperception. And of course, you do have unlimited risk, and in the cases where the markets that are usually pretty right, the market makers, when they are wrong in a straddle price, it's normally more on the straddle moves more than expected. So what I like to counsel is that if you want to sell them, okay, then that's fine, but make sure you have some protection, for these straddles. And again, like Mark said, if you want to buy them, they're too expensive. Just do your research. Go back 4 quarters, maybe 6 quarters in earnings, or if you're doing an earnings play type of strategy, and instead of maybe buying all this premium, do a butterfly out 10%, 8%. I've done that a few times. Put them on for 30 or 40 cents, and they got into $4 or $5. And you know what? When I'm wrong, I lose 30 cents. So I don't lose $18 in premium. So that's kind of what I advise customers to be very careful using straddles from the long and from the short side.
And Dan, what do you counsel your clients there when they start to realize what we're talking about here, that, hey, straddles are pretty expensive, they're very susceptible to decay, so maybe they want to flip to the dark side and start writing straddles. What do you walk them through in that scenario?
Writing straddles is something that everybody does all the time, straddles and strangles for that matter, but with protection. Iron butterflies, iron condors. These are straddles and strangles with protection. Like you talk to people and you say, I'll go out and I'll give live seminars. I was just out in Dallas like 2 weeks ago, and the topic came up about naked options. And, some of these people aren't really sophisticated investors. Some of them are. But I posed the question. I said, who out here would ever sell a naked call? And everybody kind of laughed. Like, oh, I'm not stupid. I would never sell a naked call. Well, if you're just plain selling a straddle, well, guess what? You're selling a naked call and a naked put. So it's pretty ingrained in most traders' psyche not to sell naked calls. So you would never sell a naked straddle either. And so, yeah, do them with protection. It's like in iron butterflies, like selling a straddle with insurance policies just in case.
Now, that's true. You don't see a lot of retail traders thinking it through that way, but they do have an inherent aversion to selling naked calls, yet they'll sell straddles all day long. I've never really understood that, but c'est la vie. That's the same people who will write covered calls but will never short a naked put to save their lives. That's just probably the people fall into the same camp there as well. Now, John, you hit on something else that I want to kind of touch on right now, which is the use case for straddles, both as an implied volatility tool as well as an event type of forecasting tool. There are many ways you can use straddles even when you're not trading them. John outlined one of them, which is you can look at them as a sort of prognostication tool ahead of an event, like an earnings event. I mean, looking at a name like, let's say, an Apple or everyone's favorite XYZ, going into earnings. You can look at the very, very near term, usually if it's a very liquid name, usually in the weeklies, because that's a very pure bet on that event, and see what the market is pricing that at the money straddle at. And you could see if it's, if it's a $100 name and they're pricing it at $5, well, they're expecting perhaps a 5% move in the underlying. That gives you a very clear real money estimate. This is not some analyst estimation of what's going to happen with earnings, whatever. This is real money on the line in the marketplace. And we all know those are much more accurate, much more reliable bets, if you will, than some analyst recommendation or something else like that, which is really just a guesstimate. So these straddles tend to perform relatively well when you're looking at them. And of course, they will outperform or underperform on different scenarios, and that's where you can make or lose some money. But straddles serve that function as a way to just give you some insight into what the market is expecting. So the next time you're looking at earnings in a particular name that you're trading, forget about some of the analyst stuff and instead look at what the market is actually predicting. And that will give you a good handle on what you should be doing perhaps with your underlying if you want to hedge, or if you want to get out of it, or if you want to do some other positions with options against it. That will give you some good indication of what the market is expecting, and you can go from there. And also from a volatility perspective, both Dan and John have hit on the volatility portion of straddles. Straddles are very much a pure volatility play, and that's why they have been popular with so many traders for so long. It's one of the few ways you can really put on a nice pure quote-unquote volatility bet. A lot of people like to trade implied volatility by buying straddles and then hedging, doing a delta neutral type hedging strategy. It's a little bit advanced for this show. I encourage you, if you want to learn more about delta neutral, you can of course check out theoptionsinsider.com or contact a guy like Dan or call up John over at Sogo Trade, and they'll be happy to walk you through that. But in a nutshell, that dovetails into one of the reasons why straddles, particularly from the long side of the equation, are so difficult to trade properly and effectively and indeed profitably. At the end of the day, when we were market makers on the floor, and all three of us had this experience, whenever you found yourself long premium, whenever you found yourself long gamma, particularly in a position, you were then paying decay for that position. So you had to defend against that. You had to find some way to offset that decay. Same thing with buying a straddle in a retail account. That decay is eating into your account every day. The way professionals offset that is through a technique called gamma scalping. And that takes advantage of the Greeks we've discussed earlier on this program. I recommend you go back and listen to our earlier Greeks episodes if you're confused about gamma. But essentially, it takes advantage of that gamma that you're buying in these straddles, and that if the market moves up, you can sell stock at a higher price, and then if the market moves down, you'll get short stock and you'll need to buy it back, and then of course you can lock in those differentials in the underlying, selling high, hopefully buying low, and then keep doing that over and over again. That is called gamma scalping. You're essentially scalping the underlying stock and hopefully making some money in that interim, getting long as the underlying rallies, getting short as it drops, and being able to sell and buy in that interim and offset the decay. Now, that's what professionals do in their market maker accounts with very favorable portfolio margin and very favorable margin treatment in general, and a lot of capital at their disposal. That's a much more difficult road to hoe in a retail account, which is another reason why going long straddles for a retail trader is really a difficult prospect, because you don't have all the same tools in your arsenal to defend that straddle position that a professional does. Even as a professional, it's difficult to make straddles pay off in the long run. As a retail customer, it's much more difficult. Now, John, do you have any clients over there, or have you been approached by a lot of clients who say, hey, I would like to, who are sophisticated enough to understand gamma scalping and want to implement it in a Sogo Trade account, or is that not really a big use case for you guys?
We have very few that have the capability, but one thing we had mentioned too in previous podcasts was it's going to be easier down the road for these retail customers with portfolio margining. Right now, it's much more difficult because the hedging and the buying the stock if the stock goes lower, the selling the stock as it goes higher, and then the different margin versus strategy based versus portfolio margining. So we have very few, and it's very difficult for these customers to really execute. It's really a market maker or a professional or traders, avenue. Can I mention one more thing that I just wanted to bring up? And Mark made a excellent point. It's amazing how these retail customers, and Dan at the seminar, they will never sell naked calls. But you know what? How many people of customers here sell naked puts? And it's just absolutely, and the naked call stigma, I think maybe it comes from the 80s with all the maybe takeovers, crazy takeover prices. But the amazing thing is people are so afraid of naked calls, but naked puts, people have no problem selling naked puts, even though the majority of the downside big moves, or the majority of the big moves are on the downside. It always amazes me, and it's one of the strange manifestations of, I guess, the education that the public has, but it's just very odd for me.
Of course, we talked about straddles both from the long side and the short side of the equation. We talked about gamma scalping as a professional to protect and defend that position until you can make money in the underlying move. A much more difficult road to hoe, as we said, for retail. So that raises the question then for retail, if you're putting on straddle positions, either long or short, what is the proper exit strategy, if you will? I've seen a lot of different retail customers take a lot of different approaches to this. Some of them will say they'll come in, they'll buy the $10 at the money straddle, and they'll wait till the underlying maybe rallies $10 in one direction, and then they'll sell out that one leg of that straddle to kind of cover their costs, and then hold on to the other portion and cling to it, and hopefully that's the portion where you make some money. A lot of different strategies and systems, I suppose you can call them, for lack of a better word, even though I'm not sure how much of a system they really are. But I've seen a lot of people take very different approaches to how they actually exit the straddle positions. Dan, what do you walk your clients through in these types of scenarios where they have a straddle on either long or short, and they're looking to exit it in the most profitable and efficient fashion? What do you tell them in those scenarios?
There's two techniques that work. You have a choice. Do you want to actually try and make money or not? If not, go ahead and trade like the textbooks where you just kind of sit there and twiddle your thumbs till it gets through the break-even price. Then, that doesn't work. The two techniques that I teach my students that do work is, one, when the straddle is an earnings play. And those can be tricky and precarious. You really got to do your analysis. John was talking before about going back and looking at, what'd you say, John, like 4 to 6 earnings cycles, or so. I love that. 4 to 6 sounds about right to me. Go back and look and see what I pay for this straddle with probably this very high implied volatility. Can I cover it? And then what you do is you do a one-day trade. If there's weeklies available, you buy the weekly right before the close, and then you sell it right after the open. If it worked out, great. If it didn't work out, oh well, the trade's over regardless. It's less than a 24-hour trade. So there's exit strategy number one. Exit strategy number two is, if it's not an earnings trade, it's where you have to get a little fancier. And Mark was talking about gamma scalping, and that's pretty advanced strategy, but you can kind of quasi-gamma scalp with straddles. If you buy a 10 lot and the underlying stock rises, maybe you end up selling 3, 4, 5, 6 of the calls to take profits on the calls. And then if the stock goes back down, well, then you're going to end up being short deltas because of that gamma. So you're going to sell out some of the puts and you just kind of slowly whittle down the position. It's kind of a retail-based quasi-gamma scalping strategy.
Yeah, we've seen a lot of people embrace that in the retail because you're right, that really is the only way to approximate gamma scalping in a lot of these accounts. And it takes off some of your position, but it also allows you to approximate some of the gamma scalping functionality in your own retail account. So that is a good way to do that, to kind of filter off a little bit at a time there of the position till you whittle it down to the point where you have maybe a little bit left, and then you could let that run for a little bit. But interesting stuff, and something I want to hit on too. We talked earlier about straddles going into earnings, and you're right, Dan. Clearly, there is a differential between a pre-earning straddle and a post or non-event type straddle and what goes into them. Obviously, a lot of inflated, implied volatility in that pre-earnings, pre-event straddle. I've referred to it on the show in the past as a balloon. The balloon just fills up with all this air, all this volatility, and right after the event, it pops. A lot of people look at straddles, when they're buying straddles prior to an event like earnings and think, wow, I have to buy this, and I'm making a bet that the earnings event is going to go either dramatically well or dramatically south, and this underlying is really going to move. So they buy that straddle with the intention of holding it through earnings. And the problem with that is exactly what I just described. That balloon is going to burst. No matter what happens, that balloon is going to burst. All of that implied vol is essentially going to go away. And the only thing that could save you at that point is if the earnings are a dramatic surprise in one way or the other, and the underlying moves enough to offset that inflated level of premium that you paid for that straddle. That doesn't always happen. There's been some interesting research on this front. Not enough, actually. Not as much as you think there would be, given how prominent and how impactful this topic is for a wide variety of the options audience. But there hasn't been as much research on straddles before earnings as you might think. But there has been some research that says that essentially names under $100, some of the cheaper stocks, the straddles tend to be overpriced, whereas above $100, some of the premium names, the Apples, the Googles, what have you, those straddles tend to be underpriced. So if you in general, if you buy them, it tends to work out better versus buying cheaper straddles. But regardless of that little bit of data that is out there, which isn't much, there is another approach you can take with straddles into earnings, which is take advantage of what we've been talking about on this show in the past, things like gamma and time decay, and also the fact that implied volatility increases going into the earnings events. We've seen a lot of people starting to take advantage of that and buying, let's say, straddles or just long premium positions in general ahead of the earnings event, maybe a week, maybe two. So they're taking advantage of the fact that there will be time decay, but that will be offset by, or usually be offset by, the increased level of implied volatility going into that option. So you can get a few weeks or maybe a few days worth of, maybe not free, but certainly a much cheaper long premium position in terms of decay than you would have paid in normal scenarios. And then, of course, if you get a movement in the underlying, you can sell it out and make some money. If not, you scratch it and maybe you lost a little bit of money, maybe you broke even. But you don't have to take the risk of holding it through the earnings event. It's kind of like, we kind of refer to it in some of our other shows, it's like a free juice, free premium type of play. And it's a good way for a lot of retail customers to take advantage of straddles and what they have to offer without exposing themselves to the incredible amount of risk that occurs once you hold that straddle through the actual event itself. Dan or John, do you guys counsel your clients to take that approach, or is that something you guys use on a regular basis? John, maybe we'll start with you.
Yeah, the one thing about that's actually that's an excellent point is that, you know what I found a few times before these holiday weekends, and customers have, I have myself also bought, like, let's say, spider straddles, and we've seen all the premium gets kind of sucked out, with like 2 or 3 or 4 days to go before the weekend, and basically we put these straddles on a Tuesday or Wednesday, and even after the weekend, even if nothing happens, the straddle is almost unchanged that Tuesday. So that's kind of somewhat similar to what Mark was saying. The one thing about what Mark was saying is that for the retail customer, it's a little tricky to buy the straddle 3 or 4 days before the earnings, and it might not decay, but how does a customer trade that? And I think Mark and I think Dan hit on an excellent strategy of, if it does happen to run up, and let's say the stock was 460 and you bought the 460 straddle, and 3 days before, now the stock is 475. Okay, maybe you take off some of the calls that you bought, 2 or 3, and that's a great strategy that Dan said. And that's maybe a way that you can do this gamma trading in maybe almost like in the retail sense.
Yeah, I like that discussion of the weekend effect. And you're right, it does dovetail with what we were talking about earlier with the straddles. I think that might actually be an interesting topic for a future show, the weekend effect and how time decay plays out on some of these various events like weekends, like holidays, things like that. It might be a good subject to really sink our teeth into on a future show. So perhaps I'll defer my comments on the weekend effect for now. But Dan, what's your take on that, on using the straddle pre-earnings as opposed to riding it through the rough waters of the event itself?
Yeah, it can be an interesting play, on the right stocks, and all stocks kind of have different characteristics, or specifically all different option names have different characteristics. Some of them earnings doesn't affect them much. Some of them, they don't get an implied volatility bump for earnings. Some of them get a gigantic one. And so, for the right name, could be definitely a pretty interesting way to do it. I kind of like the combination of what you and John were both talking about, where maybe I buy it a couple days before, and because you're not really going to see that decay because the implied vol probably rise at least as much as the theta decays. If you do get a little gamma move there, and you do that kind of gamma scalp, if you will, where you sell out some calls if it rises, sell out some puts if it falls. It could be a actually kind of conservative way to maybe squeeze a little money out of the market with the right setup.
Yes, and I should caution our listeners, obviously we're talking about doing this from a long premium perspective. If you're selling these straddles a couple of days before the earnings and then taking it off again, you're kind of missing the point. Remember, we just discussed that the decay is not really going to come out, so you're kind of giving away the risk of a short premium position without really getting anything in return for that. If you're doing the short premium route, you really have to hold that through the event itself, because that's when the balloon pops. That's when you get that maximum level of decay. Of course, a very risky road as well. So if you're going the short premium route, remember, make peace with those sleepless nights post earnings announcement when you don't know what's going on in the after hours and the stock can move anywhere, because that's really the only way you can collect that full, or at least the maximum amount of premium for that straddle that you sold. One last thing before we wrap up here on straddles. Dan touched on it earlier. I want to touch on it again. Is the scammer aspect of straddles. When we launched the Options Insider back in January of 2007, we started it with a post about make money in any market condition using options. And the reason we did that was because that was such a common and pervasive and prevalent pitch that a lot of the scammers and, let's say, the less reputable educators in the option space were using. You'd see them on late night infomercials. You'd see that everywhere. No matter what happens in the underlying market, you don't need to know anything. Just take this approach. And they wouldn't tell you as a straddle. That would come later. But just take this approach and you'll be able to make money no matter what happens. And who wouldn't that resonate with? That really is a very marketable approach. It clearly worked for a lot of these educational companies. They brought in a lot of clients, and of course, hooked them on straddles and sold them their courses, which essentially just taught them how to trade straddles, or told them about, I wouldn't say taught them, but told them about how to buy straddles. Usually it was buying straddles. Customers would come in, they'd spend a bunch of money, it would decay to nothing, they would lose all their money, and this company would move on to the next clientele because they'd already milked them of all of their course fees. So I would be careful of anyone coming to you and using this pitch, whatever variation it is, of make money in any market condition, make money no matter where the market moves. All of these pitches come back to straddles at the end of the day. And for all of the reasons that we've outlined here on the show today, going long straddles is a difficult road to hoe for retail. So let's summarize here for straddles. Straddle, of course, buying a call, buying a put on the same strike. So that has all the benefits and all the drawbacks that we've discussed. Pretty much double the price, double the theta, double the decay, all that fun stuff really rolled into one. Long straddles, very difficult for retail unless you put them on a few days before earnings and take advantage of some of that free decay, as long as you close it out prior to the event itself. Short straddles can work out as long as you have some sort of hedge, some sort of kicker on the outside, which is why things like iron butterflies and even iron condors have become so popular. They give people ways to get some of the benefits of short straddles without all of the risk. So it's a very defined risk trade. If you're just doing naked short straddles, please don't. That's my one takeaway from this episode. Don't take that approach. Mitigate your risk whenever possible. And also, straddles are useful tools aside from when you're trading them. They give you a good insight into what the market is expecting before a big event like an earnings announcement. It gives you a good insight into the implied volatility levels of the market, and they are a useful tool for trading volatility when you do it on a delta neutral type fashion. So yeah, a lot of interesting things going on with straddles. We've just barely scratched the surface here today, but we wanted to give you that overview of straddles. Don't get lured into those sucker pitches. Remember, straddles are a difficult prospect, even for professional traders, to execute effectively. So keep that in mind when you're looking at trading straddles and adding them to your account. And now we're going to keep on rolling right into your segment of the show, the mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call segment. This is, of course, the portion of the program where we dive into the questions sent in by you, the listeners, and you guys get to take the reins, and I get to give my voice a little rest. First up, we have a question from Alan Utchins, or Utchins, not sure how to pronounce that, sir, so forgive me for butchering your name, from Baltimore, Maryland, and he writes in with something that's just been very top of mind for me this week. A lot of email coming to the site and a lot of discussion topics on some of our other shows about this event. If you're not in the options business industry, you may not have seen it, but I'll read the question for you, and you can hear for yourself. He writes, I read with great interest the recent article about options trading in the New York Times. The article seemed to contradict everything you've discussed on this fine program. They highlighted several studies that they claimed prove that most options traders lose money. What is your response to this? Is this essentially a hit piece on the options market, or does this author have some valid points? If you missed this article, it was an article in the New York Times this weekend entitled Growth in Options Trading Helps Brokers But Not Small Investors. And I think you can tell from that title where this article is going. They essentially impugn the use of options overall and imply that A, brokers are pushing them on clientele in an irresponsible fashion, and that B, that in doing so, that has irreparably damaged retail customers because all of these options traders have lost money. And they've cited some relatively obscure studies to kind of back that up. One out of the Netherlands, one out of, I think they quote another professor from somewhere. They don't cite his article completely, showing somehow that retail options traders dramatically underperform buy and hold stock investing, which in and of itself is kind of interesting because buy and hold has essentially been disproven many times, Warren Buffett being the lone outlier. So I've had a chance to sound off on this on a couple of our other shows already. So maybe I'll give the floor to you guys first, and then I'll do my final little rejoinder here. Maybe, John, I'll start with you because this so clearly resonates with you. I'm sure this had your phone ringing off the hook this entire week. You guys obviously do a lot of options business at Sogo Trade. You clearly you sponsor an options program. You have a vested interest in the options market. So what did you think when you saw this article that essentially impugned options brokers and options as a tool for retail in general?
I mean, I think to be honest with you, I think the article is a complete hit piece. If you notice that the guys that are the main core of the article, where the article is kind of coming from, are the guys, the three guys from TD that left and now have this firm that says, oh, well, options are really bad. But you know what? Go to the Prairie Smarts or whatever the other thing was, and we'll teach you how to so you won't lose money. I mean, it's just really, I couldn't believe it. And the thing is, FX trading is supposedly 95% of the people lose money in FX, but it's still very popular, especially in Europe. I mean, it's just the basic bottom line is that if you aren't informed, you lose. If you just buy out of money calls, maybe you're going to lose all your money. But traders, if you're trained to follow the signals and you do the right thing and you aren't swayed by fear and greed and the hype and all the news, and you have discipline and you're informed, you're going to be okay. But don't read this hit piece by the New York Times. I mean, it's so wrong in the message it sends out. If you use options, we talked about this so many times. They're very flexible. They're incredibly. You can risk reducers. I don't even know where to go on. I could go on for about an hour here, but I'll let Dan chime in now.
I actually emailed the author, and he was kind enough to email me back. And, from reading the article, it was pretty clear he doesn't really have a very clear understanding of options and how they work and everything. So we kind of had a little bit of a lively discussion. Now, one of the things that he brought up is he said, well, in his email to me, was that, well, I don't have anybody who has emailed me who's a retail trader defending options, but I've had a couple people email me telling me they lost the money trading options. And my point to that was, well, that's kind of, if it bleeds, it leads media. Like when a tornado comes through a town and wrecks a bunch of houses, that was what makes the news. But if, yesterday a tornado didn't knock my house down, so nobody's writing articles about my house. It's kind of the fear mongering and they're trying to make a story to capitalize on fear and people's greed and the good old fashioned somebody's got to do something about this, cheerleading thing that makes articles sell, I guess, and makes people read them, which is what's going on here. I think it's kind of irresponsible when journalists go out and write about something that they don't have a very solid understanding about, and either demonize it or glorify it, in some other context. But that's what's going on here. Option trading, as we talk about on this show, can be very, very conservative, can be very, very risk mitigating. In fact, as far as citing studies goes, I could cite a study by Ibbetson's in the early 2000s on buy rights. And that study asserts that investors who sell a call, an out-of-the-money call, month after month after month on the market, actually outperform buy and hold investors on the market and have lower risk in terms of standard deviation. So people who use options correctly, it's been proven in this particular study that I'm citing here that they can outperform the market and have less risk than a typical buy and hold stock investor. So, look, the thing with studies and the thing with politics, everybody can cite whatever article they want, but what we're doing here on this show is we're trying to help you really understand options by giving you the truth and giving you something unbiased. And the guys trying to sell newspapers, I think, are doing something different than we're doing.
You're right. And I too had a back and forth with the author, Nathaniel Popper. To his credit, he seemed relatively receptive to contrarian viewpoints to his article, which you don't often see in the financial media. But you're right. It was very much an article with a negative overall tone for options. So, and he cited the same thing to me. The response from his readers has been negative. But it's a negative article, so you're going to receive a negative response. That's kind of how it works. People are usually more motivated in the negative fashion anyway to write in regardless of what you're talking about. When you give them fodder like that, they're going to respond rather than chiming in to defend. But what I did discuss with him, a couple of things, was first off, I thought the article didn't really delineate between the proper and improper use of options. And that clearly is lumping all options trading together. As we've seen on this show, there clearly is a responsible and an irresponsible way to do it. And lumping everyone together just doesn't serve anyone. The degenerate premium seller and the guy who's very carefully constructing collars, I think those are two different people. And putting them all together as some sort of overall options investor or trader doesn't really reflect anything. So that's my first use case, is that they really need to distinguish between proper use cases, which are, as you said, Dan, very clearly and demonstrably beneficial to the retail customer. And I provided him with a few studies. In addition, you mentioned the buy right. I sent him a Goldman SIBO buy right study that showed the same thing. Out of the money calls, a very simple strategy. Writing out of the money covered calls can demonstrably improve your overall performance. I also sent him the collar study the OCC has done for the last few years that goes back and looks at 15 years of data on the Russell and on the Q and on S&Ps and other big indices, and show that constructing collars in the right fashion from a risk perspective, it dramatically reduces the risk. And also from a total return perspective is competitive, if not outperforms buy and hold. So from a risk perspective, it dramatically outperforms. And from a total return perspective, it's competitive. So these are just two very simple studies, and these just show very simple ways that retail customers can use options to improve their returns, to say nothing of doing simple things like using cash secured puts instead of limit orders to buy stock and improve your returns that way. Once you leg into that long stock position, to write a covered call on it, then do things like construct collars, or perhaps use options as a stock surrogate to make your trading capital much more efficient and be able to trade other positions. These are all very basic, very simple things that are demonstrably beneficial to the retail customer. And at the end of the day, an article like this, it doesn't really understand or take that into account. And it's unfortunate. And it's unfortunate that's occurred in the New York Times, not some rag that people can dismiss. This is the New York Times. This is the journal of record. So people are going to give this more credence than perhaps it is due, unfortunately. But yes, listeners, if you want more data, more studies on this, hopefully if you listen to this show enough now, you understand what we're talking about and you understand what we've been outlining versus what this article outlines. But if you need data, there's places you can go. You can search for it on my site. You can, of course, course, I recommend everyone goes to optionseducation.org. That is the OCC's website and the home of the Options Industry Council, which is an industry advocacy arm. And you could say, well, they're promoting options, so they're only doing studies that work for them. But that's not true. They actually have a lot of independent studies there that show time and again these different scenarios how options strategies outperform both from a risk-adjusted basis and from a total return basis than a just simple buy and hold. At the end of the day, what you don't want to do is just be the buy and hold equity guy who goes up when the market goes up and then drops 30 or 40% when the market drops 30 or 40%. Because guess what? You haven't really learned anything from the recent meltdowns. You haven't really taken the approaches we've talked about here and learned simple things like risk management. At the end of the day, that's what options were intended for. Options were intended for hedging and for some income generation. If you use options in those intended scenarios to hedge a long equity portfolio and perhaps generate some income against it, that is a demonstrably better thing to do than just buying the stock by itself. And there are myriad examples and studies that show that. And of course, you can always listen to a show like this, which will teach you that in many different fashions. So great question there, Mr. Utchins from Baltimore. And hopefully you listen to the show enough now that you know where we stand on this. And you tend to believe us when it comes to these types of topics rather than the New York Times, a fine journalistic bastion it may be, but not exactly known for its cutting-edge options analysis and introspective. And we'll just leave it at that. Next up, we have a question from OpTrader. I think we touched on this in the past, but it's been a while, so it's good to revisit it. He writes, what books would you recommend about options trading aside from Mr. Passarelli's, of course? And since you are named in the question, Dan, I will let you go first.
Sure. Let's see. I would say, well, considering I've only actually read one book on options, I can only recommend one. I know I've actually written more books than I've read on options. The good old-fashioned Bible that every trader who ever stepped foot on the trading floor was
You're going to steal my pick.
Handed.
I know it.
Option Volatility and Pricing Strategies.
Good old Natenberg.
By Shelley Natenberg. That's the one. You should read that. It's, buy like go to Costco and buy one of those big containers, like boxes that has all the little packets of coffee in it, because you're going to need it, because it's it's a little mathematical, a little dry. But it's a good one. It lays out what you need to know.
Yeah, in terms of the Bibles, that really is it. A lot of retail, the Bible for a lot of retail was Macmillan, of course. That one had a lot of resonance with the retail audience. But for the professional options traders, the market makers, everyone literally got handed Macmillan got handed Natenberg when you walked on the trading floor, and that's what we all learned from. So if you want the true professional trader's Bible that all of us pretty much cut our teeth on, it is still Shelley Natenberg's Option Volatility and Pricing. It's how many editions it's been through now. But it's certainly, not the most scintillating of reads, but how many option books really are, except for yours, of course, Dan. They keep me up laughing and roaring throughout the night. But aside from those excellently crafted tomes, they're going to be a little bit on the mathematical side, but that's kind of what you want for this kind of educational tome. So yeah, I could definitely throw my hat in the Natenberg ring as well. Now, Mr.
Actually, can I give you
Sure.
one more? And this is not really an options book. Actually, it's a Forex book. Am I allowed to mention a Forex book?
I don't know. I'll have to ask Mr. OpTrader. I think he's good with it, though.
There's a book out there by Booker is the author's name, and it's called Adventures of a Currency Trader. And that's again, it's not an options book. It's a currency book, but I was talking to my publisher one time about maybe a year and a half ago, and I said, I've got what I think is going to be a really great idea. I'm going to write a fiction book that teaches you how to trade options, kind of tricks you into learning options. And I was all geeked out about this. I thought I came up with such a clever original idea. And he goes, oh, yeah, that's already been done. Rob Booker, Adventures of a Currency Trader. And I said, Jesus, I can't believe it. And that's what that book is. It's like a fictional story based, I imagine, somewhat on his career. But it teaches you kind of like interwoven lessons of currency trading is kind of the subtext of the book, and it's really, really interesting, and it's a good story, and it's a pretty cool idea.
Yeah, I'm not familiar with it. I'm looking at it now. You're right. It is a fable about trading, courage, and doing the right thing.
Yeah.
It makes me want to read it just for the subtitle alone. But yeah, I've never seen that. I've never heard anyone taking that approach before, so that is kind of interesting. I might have to check it out. A good pick there, sir. And Mr. John, bring us home. What are your picks, sir?
There's two books. An ex-colleague of mine, Adam Warner, has written a few books, and he actually has a good wit and a good way of explaining things. And there's another book that's about stock trading that I wanted to mention that I read in 1989 when I came down to the floor, and every 3 or 4 years I read it, or I read it back then. It's called Reminiscence of a Stock Trader by Jesse Livermore, and it's such an excellent book because a lot of our option customers, most of them were equity traders first, and they have that background. And this book is an incredible book to read about stock trading and the rules you need to keep in place. We always say rules, and this book, brings that home. So those two books are two books that I would recommend for all our customers.
Poor Mr. Op Trader. He writes in for some options recommendations. We give him one option book and a currency book and a stock book. We're making them. Actually, we gave him two. John gave him one as well. And I threw in McMillan, so I guess that's three, even though two of them, Natenberg and McMillan, kind of general picks that everyone would give. But both very solid picks. And some interesting extras thrown in for you there, Mr. Op Trader. And unfortunately, that is all the time we have for this episode of Options Bootcamp. But before we close the doors, I do want to check in with my cohorts here, my partners in crime on the old program, to see what they have cooking in their respective necks of the woods that may interest you. And starting off with you, John, I know last time we talked, you touched on your margin tool and how that was getting closer to fruition. Can you give us an update on that and how that's looking over there at sogotrade.com?
The margin tool is the optimizer, which has been a work in progress. My pet project for a while. It's about maybe a week or two away. I'm just testing it. We're going to do a soft launch, and then we're going to let everybody know. And so I'm real excited about that. And we're going to have this advanced screener available to our customers, which we have now to some customers, and that's going to be an excellent tool. And you can always read my blog, and I'm on Twitter, Solo Trade Option, but we're looking forward to the summer, and the earnings coming up in the next month or so, and should be a lot of fun.
Speaking of fun, it's always fun. It's always a game. It's always silly when you're over there at Market Taker Land. Isn't that right, Dan?
Indeed it is.
And
yes.
What's cooking in the silly, fun, entertaining, keep you up at night reading the book land of Market Taker Mentor?
Well, I've been threatening to announce a new product over here at Market Taker for a while, and you're still going to have to wait. But I think by the next show we have, I'm going to unleash something that you guys have been waiting for a long, long time. I've got a new little something coming out that some of you guys are going to love.
You're nothing but a dirty, rotten tease, sir.
And overall, we've been growing here over at Market Taker. Brought on a new person, Amy, who's going to be helping us, and that's going to be fantastic. And looks like we're going to be bringing on another instructor as well. So things are moving and shaking over here.
Things are booming in Market Taker land. If you'd like to learn more about either of those two topics or tools or areas, of course, you can find out more about the optimizer over there at sogotrade.com, or visit Dan and perhaps get a secret sneak at his upcoming sneak peek extravaganza reveal. Then surf on over to markettaker.com. You can find all of that and more. And of course, if you'd like to reach out to us here on the old program, or you have some questions or comments, you can always surf on over to theoptionsinsider.com. While you're there, you can certainly check out some of our other fine programs on the Options Insider Radio Network. Read some of our great educational articles or analysis or unusual activity, whatever floats your boat. We have our breaking news from the options market, which is always encapsulated every day by our own Dan Passarelli in our fabulous Options News Rundown program. I encourage you to check that one out. And judging by the numbers on that show, a lot of you are, so that's a great thing. So yeah, a lot of good stuff cooking over there at theoptionsinsider.com as well. So check it out. And on behalf of Dan and John and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing and, of course, writing in with such great questions. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.